What's up guys, Daddy with a new video. Today we will take a look into Bollinger Bands. So it's getting really exciting because we're taking it to its limits at the end and check it and check the performance of the Bollinger Bands strategy and with all the S&P 500 stocks over the last 12 years. So stay tuned. But before, the video basically split into three main parts. We will first talk about the theory, later about calculating everything in Python, and at the end the evaluation also in Python, and plus a little conclusion from me. So let's get started. First, a disclaimer, this is not financial advice and it's just for educational purposes to see what the trading strategy can do and how you can test it in Python. So let's start with the theory. First, a little chart how the Bollinger Bands look like. So we have four different lines. We have the blue line, which is the TP, the typical price, and we have the orange one, which is the moving average, and then we have the two Bollinger Bands. The green line is the upper one and the red line is the lower Bollinger Band. So how do we calculate it? Here we have the formula. So on top we have the formula for the upper Bollinger Band, and in the second row we have the formula for the lower Bollinger Band. So what does this letters stand for? We have MA first, which simply stands for moving average. Then we have the TP, which is the typical price. The typical price is the mean of the high, low and close value on every day. Then we have two variables. We have N, which is the number of days in smoothing period, and we have M for number of standard deviation. So this is a bit misleading. It says number of standard deviations, but I wrote it into factor of standard deviation. As we see on top, it's the variable that we multiply with the standard deviation. So to visualize it, we have N, the number of smoothing period. We take it into the moving average and into the standard deviation. We will take a look at the simple Bollinger Band strategy, and the standard here is to take 20 as the value. So you take for the moving average, you take the last 20 days to calculate the moving average, and the same for the standard deviation. And as already said, M is the variable we multiply the standard deviation with, and in our example the standard is to take 2. So just that we have it written down, for N we take 20 and for M we take 2. And the last notation is the standard deviation. So it's the standard deviation over the last n periods and for the typical price. Alright, that's it for the math part. So how exactly do we trade? Basically the Bollinger Band strategy, the simple strategy that we are using, indicates if the stock is oversold or overbought. So it's oversold if the price crosses the lower band, and it's overbought if the price crosses the upper band. So that means for us, if it's oversold we will buy, and if it's overbought we will sell. So I will show you this in the plot. So here we have the Apple chart again. Now let's draw in every time the price crosses one of the bands. So here you see it with the dots. Green means that it crosses the lower band, which means for us that it's a buy signal, and respective the red dots are the sell signals. So as you can see, we have one problem here. We always have multiple signals in a row. So for example, here we have multiple buy signals and here multiple sell signals. How will we work with this? So the solution we will take here is pretty simple. We will always take the first buy and always take the first sell signal, and we will only have one position at a time. So basically this means that we can delete these points that are now transparent, and which leaves us with these buying and sell conditions. Let's jump into the coding. So we start with 3 imports. yfinance for the financial data, matplotlib for plotting, and pandas to work with the data. First of all, we get the stock data, as I said, from yfinance. We download the Apple chart for the whole year 2021, and that's what the data frame looks like. So now in the next steps we first calculate all the values we need and write them into another column, which we just append at the end. So we start with the TP, the typical price. As we saw in the theory part, it's simply the high, the low, and the close, and divided by 3, so the mean. In the next step we calculate the moving average. And for this we take the rolling function, we roll back the first 20 we roll back 20 days and then take the mean. As you can see, we have none values here in the first rows. You don't have to worry about this. That's logical because we take the last 20 entries for the moving average and calculate the mean. But in the first rows here we can't go back 20, so it just says none. So it doesn't matter, we will clear them later. In the next step we take the standard deviation, we use the rolling function again and .std. Right, and then lastly we take the upper and lower band, which is for the upper band the moving average plus 2 times the std, and the lower band with minus. Alright, that's already all the values that we need. So just for simplicity, let's calculate the signals too. So in the first row we dropped the NA values. So you can see we don't have them anymore. And we calculate the buy and sell signals, where we simply put in a true value if the signal or if the condition for a buy is met, which is simply if the price is lower. For example, for a buy signal, if the price is lower than the lower band. So if it crosses the lower band, it's a buy signal, and the same for selling signal if it crosses the upper band. So let's plot the data. Here you have the code from the plot that I showed at the beginning, so I will not go into the details here. And now we can draw in the buying and selling signals, and to get the first buying signal and the last buying signal and only one open position, as we stated at the beginning, we have this help function here which calculates the buy dates and the sell dates. I think this is pretty self-explanatory. We have 2 lists, buy dates and sell dates, and a flag, an open position flag, which is false at the beginning, and then we iterate over our data frame. And if we don't have an open position, and the buy criteria is met, we write the date or the number of the date into the buy dates list and change the open position flag into true, and then in the else part we do the same for the selling condition. And for 2021, for the year 2021, we get 3 trades which we can draw into the plot like this. So here we see the plot we've already seen later with the code, and where we have all the buy and sells that we would have had. Alright, that's basically it for the calculations and the plotting. So let's get to the interesting part, to the evaluation. So first of all we calculate, or not calculate, but first of all we make a data frame in which we have the prices of the buys and the sells. In the next names we just change the column names, and now we will calculate the profits. So first the absolute profit for one trade will be simply the sell, or is simply the sell price minus the buy price, and which gives you the absolute profit that you would have had if you bought one stock. But it's not really meaningful to take the absolute profit, so we will take the relative profit, which is the absolute profit divided by the buy price. So if we take this calculation on our data frame, we get this percentage as this profit. So note that I took it times 100, so we get the percentage values. So the first trade would have been a minus 2%, so it would be a loss. The second trade would give us a profit of 0.4%, and the last trade would have given us a 3.6% profit. Maybe a word to how we calculate this. So basically, as we saw it right now in the formula, but we have to take the data frame cell column and shift it -1, because we don't have everything in run row, so that's why we have this shift function here. Alright, so we have a mean profit of 0.63%, which means every time we make the trade we made 0.63% profit, which is not very much if you ask me. And yeah, we have a total profit of 1.9%. So yeah, I think everyone can think for themselves if this is a good profit or not for the year. Just to have some comparison, I calculated how much profit we would have made if we would have just bought on the 1st January and sold on the 31st December. We would get a 34.6% profit for this year. So I think it's pretty easy to see what would have been the better solution here, but that's not really meaningful. So to get a better insight into the trading strategy, now we will check the Bollinger Band strategy for all S&P 500 companies since the year 2010 till today. So to do this, I got some S&P 500 data from the internet. For us, only the symbol column is important, because this gives us the ticker symbols which we will need to download the data to automate the evaluation. So how do we do this? First we read in the data frame that we have just seen. In the next step we just take the tickers out. Then we create an empty data frame named df result with 3 columns. In the first column we have the ticker. In the second column we will have the trade profit, so the profit we would have made if we would have traded this Bollinger Band strategy, and in the last column we will have the profit for the buy and hold strategy. And we start at the date 2010. So to evaluate this, now we have a for loop here, so we iterate over every ticker that we have. And then we call the test strategy function. And the test strategy function is just everything that we have coded before. I took everything and wrote it into one function. And then we give it the ticker and the start date and save it into the data frame, so we can compare it later. And if we run this, we will get this result. So as we see, we have the index first, and then we have the ticker symbol. Then we see how much we would have made if we traded, and then with the buy and hold strategy. To make the evaluation a bit easier, we create a new column which we name trade better, which will simply give a true or false value regarding if the trade would have been better than the buy and hold strategy. So we see if the buy and hold strategy would have been better, we have a false, and if the trading strategy would have been better, we have a true. And now we look how many for how many stocks the trading strategy would have been better, and for how many the buy and hold strategy would have been better. So here we have the trading strategy, and here we have the buy and hold strategy. So yeah, that was basically it with the video. Maybe my conclusion. So what you have to think here is that we just took one possible Bollinger Band strategy. So there are a lot of more different strategies that you can trade with the Bollinger Bands. We only took one here, a pretty simple one, and we only evaluated it on one time frame. So we took 2010 to today. So this is not 100% meaningful, and it doesn't prove anything, especially not for the general use of buy and hold strategy or the Bollinger Bands trading strategy. It just proves that in this time frame it would have been better to just buy and hold. Or to say it in mathematical words, the probability would have been higher to get a better return if we would have taken the buy and hold strategy. If you really want to get more insight into a comparison of two strategies like this, you have to take into account multiple time frames. We also only took American stocks here, so maybe the MSCI World would have been a better index to check. And yeah, you have a lot of possibilities, so always take statistics and data like this with a pinch of salt, and the best thing is if you make your own picture. So that was basically it. Let me know in the comments what you think about the results we have here, and let me know in the comment if you like this backtesting content, and if you would like more wider backtests in the future where we take into account different stocks from different countries and more time frames, or if you would like more focus on the coding parts, or just let me know what you think. See you soon.